Hello, everybody. My name is Victor Lai with BCM, and this is part one of a series called Learn About Stocks. So, I created this series because some of the most common questions that we get at work are about stocks and stock investing, and so I wanted to put together an easy to understand tutorial that would summarize stock investing from the basics like what is a stock all the way to an actual example of how to analyze a stock investment. Now, keep in mind, this is a general summary. My goal is not to cover, every detail or turn you into an equity analyst. I just want to help you gain a better understanding of what stocks are, how they work, and how to think about them. So, in this first part, we'll go over the basics. All right, first we'll look at what is a stock. What does it mean to own a stock? Second, where does stock come from? Why does it exist? And third, why do investors buy stock? Why in the world would anyone want to buy this stuff to begin with? In later parts, we'll look at the mechanics behind how stock pricing works. We'll look at common approaches to stock investing, and then we'll finish with an actual example of how to analyze a stock. Okay, so before we answer this first question, what is a stock? I want to clarify that there are actually different types of stock out there. The most common type is publicly traded common stock. So this is what people are talking about when they buy and sell shares of Apple or McDonald's or anything else. And that's also what we will be talking about in these videos. So what does that stock represent? Well, that stock represents ownership in a company. Normally we're talking about partial ownership. So here's an example. Let's say there's a company, we'll call it company ABC, and it has 2 shares of stock. Now, if you own 1 share of that stock and I own the other share, then we each own 50% of the company. We each own half of the company. So that stock reflects our partial ownership of the company. So in the real world, if you go out and you buy 100 shares of Walmart stock, you actually own a slice of Walmart, the company. Of course, it's a tiny, tiny sliver of ownership because Walmart has billions of shares out there, but it is still partial ownership nonetheless. The next question is, where does stock come from? Now, obviously, Walmart stock comes from Walmart, the company, so maybe a better question to ask is, why would a company want to issue stock to begin with? And the answer is usually because it needs money, right? So, for example, let's say you and I were going to go ahead and start a company. And it's going to be a company where we sell stuff online. Well, it takes money to start and run that company, right? We need a website, we need inventory, we need office space, and so on. And there are really only a few ways that we can get that money. First, we can invest our own money, whatever we have in the bank. But what if that's not enough? Well, then we can try to borrow money from other people. But family and friends, they can only lend us so much. And the big lenders like banks, they usually don't like lending money to, new companies with no history and no profits. And so a third option could be to raise money from investors by selling them shares of stock in the company. Now, sometimes business owners don't like the idea of selling shares of their company. But the truth is, it's better to own less than 100% of something than to own 100% of nothing, right? So if you and I, we own, all of this company, but it's not worth anything, what do we really own, right? But what if we could sell 50% of the company to an investor, and in exchange, that investor gives us $10,000 in cash that we can use to run the company and to grow it. Now the company has 10,000 in cash, and the investor has, his investment or her investment. Now it's more complicated than this in reality, but this is basically how it works. So, when we look at all the different stocks out there that we can buy and sell in the stock market, they all came from companies that decided to sell shares once upon a time. And that's what an IPO is, an initial public offering. It's that initial sale to the public, and that's where stocks come from. That brings us to our last question, uh, which is why would an investor want to buy stock? Now, the obvious reason is that people buy stocks because they think the price will go up. That's not the only reason. Another reason people buy stock is because it comes with control, or it can come with control. So, as an owner of a company, as a stock owner, you have the right to vote on certain matters like who sits on the board of directors, or should a certain merger go through. Now, of course, voting is proportionate to ownership. So if you own a tiny fraction of a company, then your vote probably doesn't have a lot of weight. But there are many large investors who are famous for buying, large stakes in public companies in order to gain control. Another reason someone might buy stock is because of dividend payments. Dividends are periodic cash payments that companies pay to shareholders. It's a company's way of distributing profits to owners in the form of cash. Not all companies pay dividends, but many do. Particularly the large, more established blue chip type of companies. AT&T is one good example. It currently pays a dividend close to 5% a year, and that's a relatively high yield compared to other alternatives. Now, of course, both the stock and the dividend have risks, but nonetheless, dividends can be an attractive way to generate income, and dividends are certainly one of the reasons why people will buy stocks. A third reason is that stock ownership can be a way to reflect or support values and beliefs. So, for example, we can buy stock in companies that provide products and services we really care about. Maybe we buy Tesla stock because we believe in clean energy and we believe Tesla is cleaning up the auto industry. At the same time, we could refuse to own Exxon stock because we think oil is bad. I'm not saying that's true or not. This is just an example. Some people will call this type of investing impact investing. Some call it SRI, or socially responsible investing. Some call it ESG. Whatever you want to call it, this type of belief-based investing is just one more reason why people can buy stocks. And there are other reasons too, but I'll end with the first and the most obvious one, which is people buy stocks in hopes to make money. Buy low, sell high. That's how you make money with stocks. That's the only way, actually. And so that's a perfect segue into part two of this series, where we're going to look at why and how stock prices move up and down. So to summarize, stock ownership reflects partial ownership of a company. Stock is created when companies decide to sell shares to investors for cash, and investors will buy stock for a number of reasons, the most obvious of which is hoping that the stock price will go up. Okay, so that wraps up part one. I hope you enjoyed this video. If you did, please like and share it. You can also find us on Facebook, Twitter, and LinkedIn. Links are included in the description below. We try to put out useful information at least once a month. Maybe it's an article or a blog posting or a video. But if you subscribe to our pages, then we'll keep you up to date on new content as we push it out. Otherwise, thanks for watching, and please stay tuned for some important information about this video.